After a September to remember, what's ahead for the markets in October? Let's get some thoughts from Dennis Hynes. He is the chief market strategist for RW Pressprich Co. Prior to joining RW Pressprich 2 decades ago, Dennis was a portfolio manager as well as a futures trader and a commodity trading advisor. Dennis, and you've also got a black belt in karate, second level?
Second dan.
Second dan.
Yes.
So chop through the thicket of all the noise about what's going on in the market and give us a little perspective of what's going to happen in October.
Great segue.
I thought you were going to chop, give me a little chop.
Turns out that September, as you know, I'm sure you reported this, has been the best September since 1939. It's also been the best performing month, one of the top 3 performing months in the past 10 years. Now, what's happened is retail investors have left the equity market. And the consequences of that is that what they've done is they find themselves ill-prepared to fund their retirements. So they've had to reach for yield, and they're taking some very, very dangerous chances with something called duration risk and default risk. Default risk is easy. You know that if a company goes out of business, you lose all of your money. However, duration risk is a bit more stealth, and that is that if you invest even in the Treasury market, let's say that you buy the 10-year Treasury, which is yielding at 250 basis points.
Right, 2.5%.
2.5%.
For those of us who just do the English. 2.5%, 10 years. You're loaning your money to the government.
Let's say that the PCE, which is the personal consumption expenditures model, which is what Mr. Bernanke looks at, let's say that ticks up a bit. He gets frightened. Rates move up 100 basis points. If you invest $100,000 into a U.S. Treasury, fully guaranteed investment, and rates go up 100 basis points, which is easy, you lose 10% of your entire investment.
So indeed, if rates go up 1%, if the 10-year note goes from 2.5% to 3.5%, for all those investors who lent their money to the U.S. government for 10 years and were getting 2.5%, that principal gets eaten away by $10,000.
That's correct.
But they get their money back after 10 years. That's what they seem to be counting on, right?
That's a very long-term 2.5% return. Because
Indeed.
If you think that all of this profligacy we've been talking about with this endless spending of money, this will end up, after a deflationary bout, should end up in inflation. That's the fear. That's what gold traders fear. That's what gold buyers fear. And if should that occur, then all of a sudden rates will spike up, and you will, whereas 5 years from now, you might be looking at 5 and 6 and 7% interest rates when you're still laboring with your 2.5% return.
So what is it that investors think? That they can get out when the getting is good? Because, I mean, according to the head of the New York Fed today, William Dudley, they're thinking about quantitative easing. They say the economy's not growing as fast as they want it to grow.
I quite agree with that. And so they're on the right side of that trade. What that means is that they're hoping and expecting rates to go to 0. Now, they have in the front end with the 1 year, which is currently at 24 basis points, the 2 year at 41 basis points. That means for $100,000 investment, you receive $400 at the end of the year. Well, that's nothing for anyone to use for spending. But yes, it is. We're going that way. So yes, rates will go lower, and I think they're on the right side of that trade. But I think a more appropriate place to go is I think the government is encouraging people to take risk. Not the risk that they have heretofore been taking. That means moving into junk bonds, very dangerous. Better for them to look at high-quality stocks. Those who, in fact, require fixed income, what they might look at are some great dividend payers. With some of these stocks have become value plays, and they're offering a wonderful dividend return, and I would encourage investors to look to that.
Well, indeed, just before we were doing this, I was looking and speaking with John Spooner in Boston, and we were looking at Coca-Cola and McDonald's. Both of those stocks yield more in terms of dividend than the 10-year Treasury right now.
Why is that not a better investment than the Treasury? Why is that not a better investment than junk bonds? It clearly is.
Is that because most investors, at least right now that you've seen, they're so scared of the stock market, they're worried that maybe Coca-Cola or McDonald's won't be around in 10 years?
Well, you can understand where they're coming from, because they've had a class, the S&P 500 has been an underperformer for the past decade. So what they've done is they've put their hopes and their dreams on an investment in the S&P, and they've been disappointed. So you can understand that. Now is not the time, however, to abandon. Now, I think with this great return we had this past month, we probably get investor attention back in the market. However, you need to go slowly here.
Don't let your fears guide your investing pattern.
I think you should be investing in the stock market, but I think you should do it judiciously. And that means that we've had such a big run-up. I think there's an upside to this S&P that gets us to a 1234, which is an 8% higher than where we are currently. It doesn't go straight up from there, especially as people look at this great return of more than 8%, and they start saying, well, maybe I should take some profits here, which causes a bit of a pullback. By the pullback, as long as it trades and closes above 1127, which happens to be the old 50% retracement of the bear market from October 2007 to the March 2009 low.
I'm going to imprint that number in my brain, 1127,
Yes.
because I remember you were talking about how that particular Friday we had to go through those levels of resistance. We did that. So you're optimistic about stocks, but pay attention, 1127. If we get close to that, I know I'm going to call you on the hotline.
Yes.
All right. I want to thank you very much. Dennis Hynes coming to us from RW Pressprich. Always a pleasure, always insightful. We always learn something. Thank you. All right.